Welcome to a new IFRS Educational Fund Service. It's an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standard IFRS through a multiple choice question and answer approach. It is intended to make learning verification, mastery, and intellectual assurance fun. In this session, we shall be considering cumulative set 210 questions to which the answers have been provided on IAS 87. This is standard and provisions, contingent liabilities, and contingent assets. Viewers or subscribers have 30 seconds to select or choose the answer to each question. The answers to the cumulative 10 questions are reviewed at the end of 40 questions. Please enjoy it. Question number 11. A legal obligation does not arise from A, established pattern of practice, B, explicit terms of a contract, C, implicit terms of a contract, D, legislation, E, other operation of the law. Some counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 12. Which of the following deals with a specific type of provision? A, IAS 19, B, IFRS 3, C, IAS 12, D, all of the above, E, none of the above. Some counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 13. With respect to expenses or expenditures, IAS 87 provides that A, expenses or expenditures are capitalized. B, expenses or expenditures are expensed. C, expenses or expenditures are not capitalized. D, expenses or expenditures are not expensed. E, no specific address as to whether expenses or expenditures should be capitalized. Some counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 14. A contract in which the unavailable cost of meeting the obligations under the contract exceed the economic benefits expected to be received under the contract is called A or an A, onerous contract, B, contingent liability, C, contract loss, D, executory contract, E, non-executed contract. Some counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 15. A contingent asset is A, recognized at all times, B, recognized only when contingent liability is recognized, C, not disclosed in the financial statements, D, disclosed in the financial statements, E, disclosed net of contingent liability. Some counts. Ten seconds gone. 20 seconds gone. Time up. Question number 16. Reimbursement on a provision is recognized only and only when it is virtually certain that A, provision will be made upon which reimbursement is based. B, reimbursement will be received if an entity settles an obligation. C, reimbursement will be received unconditionally. D, reimbursement is already received. E, reimbursement is more than the provision. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 17. One of these is not considered in determining the best estimate of a provision. A, uncertainties. B, risks. C, expected disposal of assets. D, present value. E, future events. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 18. Where discounting is used, the increase in the current amount of a provision in each period to reflect the passage of time is A, recognized as finance cost. B, recognized as administrative cost. C, recognized as selling or distribution cost. D, recognized as cost of sales. E, recognized as deduction from revenue. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 19. The unavailable cost of a contract reflect the A, highest net cost of exiting from the contract. B, average net cost of exiting from the contract. C, least net cost of exiting from the contract. D, expected value of exiting from the contract. E, future value of exiting from the contract. Some count. 10 seconds gone. 20 seconds gone. Time up. Question number 20. The least cost of exiting from a contract is A, the lower of cost and net realizable value. B, the lower of current amount and fair value less cost to sell. C, the lower of fair value less cost of disposal and value in use. D, the lower of cost of fulfillment and penalties for non-fulfillment. E, the lower of planned assets and planned liabilities. Some counts. 10 seconds gone. 20 seconds gone. Time up. We proceed to reveal the answers. Question number 11. The answer to question number 11 is A, Established pattern of practice. A. Established pattern of practice. A legal obligation is an obligation that derives from A contract which may have explicit or implicit terms, 2, legislation, or 3, other operation of the law. Established pattern of practice is an obligation derived from an entity's action. It is a constructive obligation, not a legal obligation. A is the answer to question number 11. Question number 12. The answer to question number 12 is D, all of the above. D, all of the above. IAS 19 employee benefits deals with specific type of provision related to employee benefits like other long-term employee benefits and post-employment employee benefits. IFRS 3 business combinations in the same vein deals with contingent consideration of an acquirer in a business combination. IAS 12 income taxes prescribes how current and deferred tax can be estimated or measured specifically. It is noted that IAS 37 deals with provisions, contingent liabilities, and contingent assets not dealt with specifically by other standards. D is the answer to question number 12. Question number 13. The answer to question number 13 is E. No specific address as to whether expenses or expenditures should be capitalized. E. No specific address as to whether expenses or expenditures should be capitalized. IAS 37 provisions, contingent liabilities, and contingent assets neither prohibits nor requires capitalization of the costs recognized when a provision is made. Other standards specify what expenditures or expenses are treated as assets or expenses. E is the answer to question number 13. Question number 14. The answer to question number 14 is A. Onerous contracts. A. Onerous contract. Onerous contract is the contract in which the unavailable cost of meeting the obligations under the contract exceed the economic benefits expected to be received under it. A is the answer to question number 14. Question number 15. The answer to question number 15 is B, disclosed in the financial statements. D, disclosed in the financial statements. While contingent assets are not recognized on the face of financial statements, they are disclosed as part of the notes to the financial statements under IAS 37. D is the answer to question number 15. Question number 16. The answer to question number 16 is B. Reimbursement will be received if an entity settles an obligation. B. Reimbursement will be received if an entity settles an obligation. IAS 37 provides that where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, the reimbursement is recognized when and only when it is virtually certain that reimbursement will be received if the entity settles the obligation. B is the answer to question number 16. Question number 17. The answer to question number 17 is C, expected disposal of assets. C, expected disposal of assets. All the options of answers are considered in determining the best estimate of a provision except option C. Gains from the expected disposal of assets are not considered. Future events that may affect the amount required to settle an obligation is reflected in the amount of a provision where there is sufficient objective evidence that they will occur. C is the answer to question number 17. Question number 18. The answer to question number 18 is A, recognized as finance costs. A, recognized as finance costs. Where discounting is used, the current amount of a provision is increased in each period to reflect the passage of time and time value of money. The increase is recognized as a borrowing cost, which is a component of finance cost. A is the answer to question number 18. Question number 19. The answer to question number 19 is C, least net cost of exiting from the contract. C, least net cost of exiting from the contract. The unavoidable cost under a contract is the least net cost of exiting from the contract. C is the answer to question number 19. Question number 20. The answer to question number 20 is D, the lower of cost of fulfillment and penalties for non-fulfillment. D, the lower of cost of fulfillment and penalties for non-fulfillment. The unavoidable cost under a contract is the least net cost of exiting from the contract. The least net cost of exiting from the contract is the lower of the cost of fulfilling the contract and any compensation to be paid or penalties arising from failure to fulfill it. D is the answer to question number 20. That is all for this set 2. Thank you for joining us for the set 2 of IAS 37. Provisions, contingent liabilities, and contingent assets. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all those subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and orders in this service are reserved for OJ Inspection Limited. Thank you once again, and bye for now.